What are the regulatory risks of crypto OTC desks? Imagine trying to navigate a busy city street without clear traffic signs. That's similar to how crypto over-the-counter desks operate in a world full of changing rules. These desks handle large trades directly between parties, outside public exchanges, offering privacy and tailored deals. But just like city streets have rules, these desks face strict regulations that can change from country to country. Different nations treat cryptocurrency transactions differently. Some see them as assets, others as securities or commodities. This means OTC desks must follow a patchwork of rules from various authorities. For example, in the United States, these desks are considered money services businesses by the Financial Crimes Enforcement Network and may also be regulated by the Securities and Exchange Commission or the Commodity Futures Trading Commission, depending on the assets traded. They need to follow Know Your Customer rules, report large transactions, and keep detailed records. In the European Union, OTC desks need licenses under the Markets in Crypto Assets regulations and must follow anti-money laundering rules and report certain derivatives trades. Countries like India and the United Arab Emirates also have their own licensing and compliance standards. If an OTC desk doesn't follow these rules, it can face hefty fines, losing their license, or damage to their reputation. Another big concern is anti-money laundering and Know Your Customer compliance. These desks verify who their clients are to prevent illegal activities like money laundering or terrorist financing. Because OTC trades are private and involve large amounts, regulators are paying more attention. If a desk skips proper checks, it can get fined or face legal action. Counterparty risk is another issue. Since OTC trades happen directly between two parties, there's always a chance one might not deliver the assets as promised. Proper regulation helps reduce this risk by requiring desks to use secure custody methods like multi-signature wallets or licensed custodians. Operational risks also come into play. OTC desks must keep accurate records of every trade and report suspicious activity to authorities. If they fail to do this, they can face legal trouble or be cut off from the market. Because these desks don't display live order books like regular exchanges, questions about fair pricing and market manipulation can arise. Regulators worry that the lack of transparency might hide unfair practices. Fees on OTC desks are often negotiated and customized, especially for institutional clients. These fees can include spreads, commissions, or service charges, and must be clearly disclosed to avoid regulatory issues. Since these trades are private and large, regulators want to ensure everything is above board and well documented. Choosing a fully licensed and transparent OTC desk is key. It reduces regulatory risks and makes sure your trades are secure. Overall, the main regulatory risks involve navigating complex rules across different countries, ensuring strict anti-money laundering, and Know Your Customer compliance, managing counterparty and operational risks, and maintaining transparent reporting. These risks are especially important because OTC desks operate in a private space with large trades, making rigorous compliance essential for legal and safe trading.